Hey everyone, and welcome. So, have you ever heard of a company giving out bonus shares? I mean, the word bonus alone gets you thinking, right? It sounds like you're getting free money, which is always exciting for an investor. But is it really that simple? Let's dig in and demystify what's actually going on here.
And this is the million-dollar question, isn't it? The company you've invested in announces, hey, you're getting more shares and you don't have to pay a thing for them. It totally feels like a windfall, like cash just appeared in your account. But is that what's really happening? Let's find out.
All right, so first things first, what even is a bonus share? Well, it's pretty much what it sounds like. It's when a company issues brand new shares to its current shareholders, and yep, they're completely free. The number of shares you get is based on how many you already have. So, for instance, a company might say they're doing a 1-for-2 bonus issue. That just means for every 2 shares you own, you get 1 shiny new one.
Okay, definitions are great, but to really get how this all works, we need to crunch some numbers. So let's walk through a specific scenario step by step to see what actually happens to the stock price and the company's value when a bonus issue goes down.
Okay, so let's set the stage. We've got a company with 200 million shares out there. The share price is sitting at 12.40 agorit. Then they announce a 50% bonus issue. Now that ratio is the key. A 50% bonus means for every 2 shares you own, you're getting 1 new one. Right off the bat, we know the total number of shares is about to go way up. And that brings us to the most important question. If you suddenly have a whole bunch of new shares on the market, but the company itself hasn't changed, what do you think happens to the price of each individual share? Does it stay the same, or does something else have to give?
Now, you might guess that the price would be all over the place, but believe it or not, there's a precise formula for this. The market has this really cool built-in way of correcting the price automatically. It all comes down to a simple calculation, and this is what makes sure the company's total value doesn't just magically inflate overnight. Let's check it out.
So, to get this formula, we only need to know 2 things. First is P-cum. It's just a fancy term for the share price right before the bonus happens. Think of it as the before price. The second thing is BR, which is our bonus ratio. We just write it as a decimal. So for a 50% bonus, our BR is simply 0.5. Easy enough, right? And here it is, formula number 1. This is for the new price, which we'll call PX. All you do is take the old price, PKM, and you divide it by 1 plus the bonus ratio. It's that simple. And this little piece of math right here, this is the key to busting that whole free money myth. Let's plug in our numbers and see it in action. We take our original price, $12.40, and we divide it by 1.5. Where'd I get 1.5? That's just 1 plus our bonus ratio of 0.5. And what do we get? The new adjusted share price plummets to about 827 agora. So just as we suspected, the price had to go down. Okay, so we figured out that the price per share drops. But remember, that's only half of the story. We've got to look at the other side of the coin, all those brand new shares that just flooded the market. And hey, guess what? The formula for figuring out the new number of shares is just as easy. To find the new total of outstanding shares, or OSCOM, you just take the original number of shares, our OSKM, and multiply it by 1 plus that same bonus ratio. So let's run the numbers for our example. We started with 200 million shares. We multiply that by 1.5, and voila! The new total number of shares out there is 300 million. So, you see the pattern? We have more shares now, but each one of them is worth less. All right, this is where it all comes together. We've got our new lower price, and we've got our new higher share count. Now we can finally put these 2 pieces together to answer our big question. What actually happened to the total value of the company? This is the moment of truth. So let's look at this side by side. Before the bonus, it was 200 million shares, each worth 12.40 agorit. Afterwards, it's 300 million shares, each worth about 827 agorit. The number of shares went up, the price per share went down. So what happens when we multiply these out to find the company's total worth in both cases?
Well, our source material spells it out for us perfectly. It says, the value of the company does not change. What changes is only the number of shares. You know, it's like a pizza. The pizza is the exact same size, it's just been cut into more, smaller slices.
And the math proves it. Before, 200 million shares times 12.40 agorit is 2,480 million. And after, 300 million shares times roughly 827 is, you guessed it, also about 2,480 million. The total market value, the size of the pizza, is exactly the same. No new value was created out of thin air.
So let's break down the illusion of free. It's a simple three-step process. 1. The company creates more shares. 2. The market price for each share automatically drops to make up for it. And 3. The total value of your investment stays exactly the same. You just own more shares that are each worth less.
And that leaves us with one last, really interesting question. If bonus shares don't actually create any new value, why on earth do companies even bother issuing them? Well, the answer gets into some fascinating stuff about investor psychology and market strategy. So, the next time you hear about a bonus issue, you'll know exactly what's going on. It's not free money, it's just slicing the pie differently. Thanks for tuning in.